Today, we're tackling a topic that opens the door to homeownership for millions of Americans: how to qualify for an FHA loan. Whether you're a first-time buyer, rebuilding credit, or simply need a more flexible path to owning your home, understanding the FHA loan process is crucial. We'll break it down step by step, focusing on credit scores, income, and all the essential requirements. From A to Z, let's demystify this together. First things first. What is an FHA loan? The Federal Housing Administration, FHA, part of the U.S. Department of Housing and Urban Development, HUD, doesn't actually lend you the money. Instead, they insure loans made by approved private lenders, like banks and mortgage companies. This insurance protects the lender if you default. Why is that a big deal? Because it allows lenders to offer mortgages with more flexible qualification requirements than conventional loans. Think lower down payments and more forgiving credit standards. So, how do you qualify? Let's start with the cornerstone, your credit score. The magic and flexible number. Minimum threshold. While many conventional loans demand scores of 680 or higher, FHA loans are significantly more accessible. The absolute minimum credit score required by the FHA is 500. The sweet spot. However, the score dramatically impacts your down payment requirement, 580 and above. This is the golden zone. With a credit score of 580 or higher, you typically qualify for the FHA's minimum down payment of just 3.5% of the purchase price. 500 to 579. If your score falls in this range, don't despair. You can still qualify, but you'll need a larger down payment, at least 10%. You'll also likely face higher interest rates and potentially stricter scrutiny of other factors. Beyond the number, lenders don't just look at the score itself. They will also examine your credit report for patterns. What do they want to see? A history of on-time payments, especially on major obligations like rent, utilities, car loans, and previous mortgages. Limited derogatory marks. While some past issues, like a short sale or even a bankruptcy, aren't automatic disqualifiers, we'll cover exceptions later. Excessive recent late payments, collections, or judgments can be red flags. Manageable debt. How much credit you're using compared to your limits, credit utilization, matters. Aim for below 30% on credit cards. Next pillar. Proving you can afford it, your income and debt stable and verifiable income. Job history. Lenders want to see consistency. Typically, they look for at least 2 years of steady employment, preferably in the same field. Gaps need explanation. Self-employed? Be prepared to provide extensive documentation, usually 2 years of tax returns. Income sources. This includes your salary, wages, overtime, bonuses, commissions, social security, disability, alimony, child support, if you choose to use it, and even certain types of government assistance or rental income. All income must be documented. Pay stubs, W-2s, tax returns, and bank statements are your friends. Debt to income ratio, DTI, this is huge. Your DTI compares your total monthly debt payments to your gross monthly income, income before taxes. FHA has specific limits. Front-end ratio. This is your proposed new housing payment, mortgage principal and interest, property taxes, homeowner's insurance, and FHA Mortgage Insurance premium MIP, divided by your gross monthly income. FHA generally allows up to 31%, though exceptions exist with strong compensating factors. Back-end ratio. This is your total monthly debt obligations, housing payment plus car loans, student loans, credit card minimum payments, child support, etc., divided by your gross monthly income. FHA's standard limit is 43%, but again, this can sometimes be stretched to 50% or even higher with very strong compensating factors, like a large down payment, significant cash reserves, or an excellent credit history beyond the score. Think of it like this: If you earn $5,000 per month before taxes, your ideal total monthly debts, including the new mortgage, shouldn't exceed $2,150, 43% of $5,000. Your housing payment specifically should ideally stay under $1,550, 31% of $5,000. The down payment. Making it possible the 3.5% advantage. As we discussed with credit scores, the minimum down payment is 3.5% for borrowers with credit scores of 580 or higher. On a $250,000 home, that's $8,750, significantly lower than the typical 5.20% required for conventional loans. Where does it come from? The FHA allows your down payment to come from several sources. Your own savings, verified with bank statements. A gift from a family member, with a signed gift letter and proof the giver has the funds. Grants from government or non-profit programs. Proceeds from selling personal property, documented. Crucially, the money must be seasoned, meaning it's been in your account for a certain period, usually at least 60 days, to show it's yours and not a hidden loan. Protecting the loan. Mortgage insurance premium, MIP. The trade-off for flexibility. Because FHA loans accept borrowers who might be riskier, they require mortgage insurance premiums, MIP. This protects the lender if you default. There are two parts. Upfront MIP, UFMIP. This is a one-time fee, usually 1.75% of the base loan amount. So, on a $240,000 loan, that's $4,200. You can pay this at closing or, more commonly, roll it into your loan amount, meaning you finance it and pay interest on it over time. Annual MIP. This is an ongoing premium paid monthly as part of your mortgage payment. The rate varies based on your loan term, 15 or 30 years, your loan amount, and your initial loan-to-value ratio, LTV, how much you borrowed versus the home's value. It typically ranges from 0.15% to 0.75% of the loan amount annually, divided by 12 and added to each monthly payment. Important note. Unlike some conventional loans where you can cancel PMI once you reach 20% equity, FHA MIP generally lasts for the entire life of the loan if you put down less than 10%. If you put down 10% or more, MIP typically cancels after 11 years. This is a significant long-term cost factor to consider. The property itself. Meeting FHA standards, not just any house. The home you want to buy must also qualify. FHA requires the property to be your primary residence. You plan to live there most of the year. Investment properties and most second homes don't qualify. Appraisal is key. An FHA-approved appraiser must evaluate the home. This isn't just about value, it's a safety and soundness inspection. The appraiser will check for structural integrity, foundation, roof, walls, safety hazards, exposed wiring, broken windows, missing handrails, functioning systems, heating, plumbing, electrical, adequate property access, no fixer-upper surprises. The home must be move-in ready. If the appraisal identifies significant issues, called required repairs, the seller must fix them before closing, or the loan won't be approved. You generally cannot use FHA financing for homes needing major rehabilitation, though there is a separate FHA 203(k) rehab loan program for that purpose. The process. From application to keys, the step-by-step journey. A. Check your credit. Get free reports from annualcreditreport.com. Know your score and address any errors. B. Budget and save. Determine what you can realistically afford. Use online calculators. Start saving for your down payment and closing costs, typically 25% of the loan amount. C. Get pre-approved. This is critical. Contact an FHA-approved lender. They will pull your credit, verify your income and assets, and give you a written pre-approval letter stating how much you can likely borrow and at what terms. This shows sellers you're serious. D. Find a home and make an offer. Work with a real estate agent. Ensure your offer is contingent on FHA financing and appraisal. E. Formal loan application. Once your offer is accepted, you'll complete a full mortgage application with your chosen lender. F. Processing and underwriting. The lender's team verifies everything: income, assets, credit, property details, appraisal. The underwriter makes the final loan decision. G. Closing disclosure. CD. At least 3 days before closing, you'll receive the CD detailing your final loan terms and closing costs. Review it carefully. H. Closing day. Sign a mountain of paperwork. Pay your remaining down payment and closing costs, if not rolled in. And finally, get the keys to your new home. Special circumstances and final tips: bankruptcies and foreclosures. Past financial troubles aren't necessarily permanent roadblocks, but there are mandatory waiting periods. Chapter 7: Bankruptcy. Typically 2 years from discharge date. Chapter 13: Bankruptcy. 1 year of on-time payments and court permission. Foreclosure. Generally 3 years. Exceptions can sometimes be made with documented extenuating circumstances. Shop around. FHA loan terms, interest rates, lender fees can vary significantly between approved lenders. Get quotes from at least 3-4. Be prepared. The process requires significant documentation. Respond promptly to your lender's requests to avoid delays. Consider homebuyer education. HUD-approved counseling courses are often free or low cost and provide invaluable knowledge, especially for first-timers. Some lenders or programs might even require it. Qualifying for an FHA loan is a structured process, but it's designed to be achievable. By understanding the key pillars: a manageable credit score, starting as low as 500 with 10% down, or 580 plus for 3.5% down, stable and verifiable income within reasonable debt limits, the 3.5% down payment advantage, the reality of MIP costs, and ensuring the property meets standards, you can confidently navigate the path. Remember, preparation is power. Check your credit, save diligently, get pre-approved, choose your lender wisely, and be ready with your documents. The dream of homeownership, backed by the flexibility of an FHA loan, is absolutely within your reach. Take that first step today.